Hello, Chris.
Oh, Lucy.
So thank you for joining me on this. We just wanted to have a chat about what you're doing and how it might be really helpful for people to understand a bit more about how a lifetime mortgage can be of real benefit to them. What we were talking about earlier before we came on to do this is just how obviously how interesting it is that the mortgage market has opened up considerably, because now that there's a lot more lenders coming on board, you know, for people of a younger age in terms of looking at the property market and generating a bit of oomph back in that property market. And hopefully it starts so it gets the housing things moving again. But of course, what happens when you get to your 50s and 60s, you know, your options kind of look a bit different. And actually, when you're that age, you sort of probably think you'd quite like to pay your mortgage off. So tell me a little bit about what you do and who it benefits.
Okay, so I'm the founder of Blue House Equity Release, so I've been in financial services 40 years, and this equity release market for 20. So it's something I've been doing for a long time, and equity release is for people over 55 who are homeowners, and it's quite a young age to think about doing equity release. So it's really probably the biggest market is probably those people that are between the ages 65 and 75. They're the people that are finding reasons to why they want to release money from their house. And that could be for all sorts of reasons. You know, so they might want a new kitchen and they want to use equity release for that. They want to do home improvements. They might want to gift money to children, grandchildren. You mentioned about the mortgage market. You know, I mean, there's a couple of things recently where there's a lot of demand for properties and there's not a lot of properties on the market. So house prices have gone up a little bit. I think in the South East about 6% I saw last night. And then you mentioned about really, I suppose, a bit where people are gifting money to children in order to help them get onto the property ladder. I'm not quite sure if I got the percentage quite right, but I believe it's something like 40% of people have actually helped children or grandchildren getting onto the property ladder by gifting them some money to help with the deposit.
Wow, that's a lot.
It is a lot of people, and I'm quite surprised by it. I think because of the stamp duty reduction, people have seen a great opportunity to save a lot of money here and get onto the property ladder. You know, in fact, I spoke to somebody yesterday who had done equity release. Somebody I know who I've not known before. Spoke to him for the first time ever yesterday, because you might be thinking, why didn't I do it? But a few months ago, he started the process of equity release because he wanted to give his daughter some money to help her get onto the property ladder. So there's a lot of people doing this stuff at the moment for all sorts of reasons. And of course, we've also got people in their around 65 where lenders are actually writing to them and saying, you need to repay your mortgage. We need you to repay it. And the reason being is because lenders have to, under solvency, have to have more. You know, if you've got £100,000 of loan, they've got to cover that 2 or 3-fold as having money in the bank. So that means if they've got a mortgage that you're never going to repay, they've got their money sitting around that they can't lend it, because obviously if it's an interest-only mortgage, all you're ever doing is paying the interest. And a lot of these people are probably finding that their view is they've got to 65, actually the mortgage stops. But actually, what they're finding is it doesn't, because it's interest only. It will go on forever, but the lender doesn't want it to go on forever. And of course, then people are in that situation where they're thinking, "Gosh, what do I do?" And they might think about a mortgage, and they can get a conventional mortgage. They can get what's called a RIA, a retirement interest only mortgage. But it's all down to income and affordability. And if you can't afford it any longer, because let's face it, if you've retired, your income's gone down. You may not be able to get the multiples that's required that says you can have a mortgage of that size. And then someone says, what do you do? And well, you're going to have to move to an area far away from where you are now, away from friends and family, in order to get rid of that mortgage and buy a property of a similar size and ilk to what you've got. And of course, people have worked years to get to where they wanted to be, and then suddenly this is a shock. But the great saviour is that somebody will hopefully say to them, there's this thing called equity release. And if you speak to somebody, then you can find out how you can actually find a solution to that and pay that mortgage off. Now, equity release is a lifetime mortgage. It's still a mortgage. The difference is that you don't have to make payments. So you can let the interest roll up, and at the end of it, the house is sold after death, second death if it's a couple, and then the loan is taken out of that and the balance goes to the estate. But the great thing is there's been great innovation over the years, and what we find is, of course, now we've got products that says actually you can pay up to 10% a year of the capital off if you want to. So that means you can pay some or none in any given year if you want to or you don't want to. So it makes it very flexible, and there's no income requirement. You don't have to earn a certain amount. Equity release is simply based on your age, youngest if it's a couple, and the value of the property, and that represents a percentage that you can take of the property value. So, you know, if you're in your if you're about 65, you know, it's going to be something in the region of around about 30-something% that you can take of the property value. And if it's to repay a loan, of course, it's got to be enough to repay it. Okay, and if there's any balance that you want to take over and above that, if it's available, you've got that to take out and spend on whatever you want.
So what you mean by that is if so break it down to real layman's terms here. So let's just say I'm 65, 67 years old. I've still got an outstanding mortgage on my property, but actually I'm quite keen on looking at equity release because I've got a really nice house, not loads left to pay off on it, but actually for various, you know, reasons in my life, you know, maybe I'd like to buy a house in France or put a swimming pool in.
You can do that as well. You can take money out of your property and you can use it toward purchasing a property elsewhere.
Okay. So that loan effectively just stays with me, even though I haven't got to make any payments on it until I die, basically.
Yeah, it's a lifetime mortgage and the interest rate is fixed for life. And interest rates at the moment actually are the lowest interest rate is around about 2.5%, but they do go up between 2.5% and 7%, depending on the amount of money you want to borrow. Just like a normal mortgage, where if somebody gives money and you've got a bigger deposit, that means generally you'll get a lower interest rate on your mortgage that you've got because you put more into it. Mm-hmm. So the opposite sort of applies in a way with equity release, is the fact that actually if you take less, you're likely to get a much lower interest rate. If you're taking the maximum, you're going to be around about more of a higher interest rate. But equity release is about interest rate. It's about the product doing what you want and then the interest rate that comes with it, basically. But obviously, we're looking at the product that does what you want to get the lowest interest rate as well. Okay.
You probably got access to, you know, the people that you talk to about this probably have access to, I don't know, hundreds of different variations, do they, or many different variations?
Yeah, I mean, you know, my business is about information to people. Mm-hmm. I don't actually give advice. You know, I give information to them. I want to be in a position where they're not feeling they're being sold. Yeah. They're actually getting information and understanding what it does. And then if they actually go, I get that and I want to do it, I then move them on to actually getting actual advice. Okay, that advice is national, and it also means that I use people that are whole of market and independent.
Yeah.
So that means they're going to get, and you mentioned number of products. I think there's something like, I mean, in 2016, there was like 32 products. Now, I think we're nearly at 500.
Wow.
So there's been a massive, massive innovation in products for clients because this market is just growing, and, you know, they're finding that people need all sorts of solutions, and they've reacted to that, and the market's produced it. So, you know, from that point of view, you know, it couldn't be a better place than with an independent whole of market advisor to do that for you.
So are you finding that people are looking at equity release because of debt issues, or is it more the fun stuff?
It's a mixture. It's what we call needs and wants. So, you know, you've got people who need things. They need to repay that mortgage because the lender suddenly said, oh, you've got to pay this big mortgage you've had for all these years. Yeah. Or it might be they've got credit cards. You know, I think from a credit card point of view, I remember talking to an advisor a number of years ago, and some people had, one person had a credit card debts of £900,000, which is sort of unbelievable. That you take that.
Credit cards? How do you even get that?
Credit cards.
Jeez,
yeah, I mean, it's one of those things where, you know, people change credit cards from one to another and pay the minimum.
People, yeah.
and it becomes impossible to pay it. So, you know, we get people who want to pay mortgages off, they want to pay credit cards off, they want to pay loans and other debts off. So yes, that probably accounts for quite a fair chunk of what people use the money for. But on the other side of the coin, of course, there are lovely things like gifting money to the kids, because you can help kids out now, whether it's for house purchase or whether it's to go towards their business. Or it might be that, you know, I mean, I've got a client now who is buying a house that's £100,000 more than the one they're selling. They're age 72. They're buying a lovely 4-bed detached from a 3-bed semi. So they're getting their dream. Yeah. Okay. Because most people think, why would you do that at 72? But it's their dream. It's what they want. And they can use equity release to what we call uplift into doing that.
Most downsize, don't they? You get to a certain age, kids have left home, what have you. Lots of people choose to downsize rather than upsize.
Well, I think that not everybody upsizes. It is a small percentage of people, but more people are doing it now than they ever did before. And the reason for that is because they never realised they could do it. But the other thing, of course, is that you know, you get people who want to move maybe down to the coast. You know, we're in Kent. They might want to go down to Bournemouth or somewhere, which I've got to say Bournemouth is one of my favourite places. And they want to buy a lovely bungalow down there. And don't realise actually the prices of bungalows, as we know, are more expensive. But down there, they're even more expensive. If you want to get nearer the sea, they get even more expensive. So people will find they get there and they find they need a little bit more money than they thought, and that they can use extra to get their dream. But of course, you know, other people, you know, they're happy with their house. Not people downsize simply because they believe that's the only thing they can do. Equity release allows them to go, actually, I can stay in this house that I've worked all these years to get. Yeah. We love it here. All our kids around us. We've got the doctors, the dentist, all those things all around. We don't really want to move, but we'd like some more money. And what someone says is they go, well, if you downsize to buy something cheaper, you can put 100 grand in your pocket. Well, that's great. If you want to do it, it's a way to do it, and you can do it. And you know, it's seen as the best advice to do that. You know, so if you want to do that, then you should do that. But if you want to stay where you are and you want that 100 grand to do other things, like put a new kitchen in, maybe go towards buying another property or share a property with somebody or something, or whether you want to buy, you know, the client we had some time ago wanted to buy a vintage type Jag, you know. If you want to do those things, you can get the money out of your house and do it, and it's tax free because it's your own money. Okay.
What colour type Jag does he get? I need to know.
I don't actually know, to be honest. I can't remember what colour it was, but the fact is that people can have their dreams, and it might be that you want something as simple as a new Ford Focus. You don't want a particularly expensive or wonderful car. What you want is something that's going to give you problem-free motoring, reliability. Yeah. Everybody's different. Some people will want the supercar, some people will want, I've got a brother who actually will have a car that goes from A to B, could afford something a lot more, but he doesn't. Yeah. We're all different. But so someone else might want the super duper kitchen, and they might want to use money for that. So again, it might be just having more holidays, more super holidays.
Because you want to enjoy yourself, let's be honest. I mean, pensions is a whole nother, conversation for another time and other people. But, if you've not built up a sufficient pension, you think, do you know what? I've worked so hard all these years, really fancy going to the Maldives. In fact, let's go every year. That money's got to come from somewhere. And, this is a really good option, I guess, isn't it?
It is. I mean, if you look at pensions, a lot of people have got pensions that are maybe odd pots of money from different employers, and it might be roughly on average about 30,000 a pot. But if you take the fact that you're only going to get 5% these days, or thereabouts, maybe even a little bit less, or maybe a little bit more, but that 30,000 is only going to give you £1,500 a year. And if you've got two of them, that's three. If you've got three of them, that's £4,500. Well, it's nice to have it, but it's not necessarily going to be enough on top of state pension to make that really comfortable, wonderful life that we all dream of. And I think a survey was done that most people look at it and think of an income of around £17,000 a year. Well, if you look at pension incomes, it's probably somewhere between state pension, that is, it's probably somewhere between 7 and 10, depending. So that means there's a shortfall of somewhere around 7,000. So, people might not necessarily be taking money for that lump sum. they might be wanting to do what we call a drawdown, where they have a facility to take money out of as and when they need it. And, you know, it might be that they can afford to live, but they haven't got the money for those holidays, or if they want to replace the car or do those other things in life. But that allows them to take the money out when they want. And the beauty of that is they only pay interest on the money once it's taken out, and only on the amount that it's taken. So what's left in the pot doesn't have any interest added to it. It's just sitting there waiting for them to take it out whenever during their lifetime they want to.
And that's a different thing to equity release, is that?
No, it's the same. So equity releases, you can take either a lump sum of money.
Oh, I see what you're saying. Yes, yeah.
Or you can take a smaller lump sum of money and you have a drawdown facility for another amount. So you might take 30 grand out for the new kitchen and the car, but you might have maybe 60 or 80 or 90,000 pounds in the pot available for you to take during your lifetime when you want to take it. Some people may never take that money. They may have wanted it, but never actually use it, or only use a little tiny bit. Yeah. Or they might find that actually something happens in their lives. Maybe their son, their daughter gets into a problem with the business, and then they're being faced with a big bill, or they need extra cash flow. And mum and dad are going, actually, we've got this money sitting here. We'll help you with that.
Yeah.
It wasn't what they did it for, but sometimes those emergencies come, but they're in that position of going, actually, I can help you. But yeah, it's a drawdown, what they call drawdown.
So that's a lovely reassuring pot of available money should you need it, or should you decide to dip into it.
Yeah, and that only comes when you see an advisor who will sit down, and that advisor will do what we call creating a shopping list, really, of what you want the money for, how much you want, and when do you want it. If all that money is immediate, then you'll be doing a lump sum. If a few of those things are immediate, you don't need a great big lump sum. But some of the things might be in the future. It might be that they want to pay for their daughter's or granddaughter's wedding in a number of years.
Absolutely, they're expensive.
Yeah, so you don't want to take that money out today and be paying, 2.5%, 3%, 4% on that compound interest as well, when you put it in the bank and get 0.0 or 0.1% or whatever it is, which is very, very low. It doesn't make any sense to do that. And that's why drawdowns came about, because people were taking big lump sums of money out, which they didn't need all of it. Yeah. It was needed now and some in the future. And what I think it was something around probably about 2006 that equity release providers, those people that lend the money, actually thought, well, it's not really the right thing. We need to come up with a new product. And the new product they come up with was drawdown, which simply said, we understand you want some money now, and it's other money you don't need yet. So why would you take it and pay interest on it when you don't actually yet need it?
That's really smart. I like that. So what happens then? So fast forward, and you've passed away, and obviously, what's left in your estate is, it is not the volume that was once there, because of course you've taken a drawing from the estate.
Yeah. I mean, if you had a £300,000 property, and you took out, let's say, 50,000. It will be payable in the event of the last death if it's a couple, okay? Or if you go into long-term care. That's the last of them to go into long-term care. Mm-hmm. And of course, over those years, the interest would have been added onto it, so compound interest. So if you'd never made any payments, if you're looking at a rate of around 2.5%, that would probably take something like 18 or 20 years before it would double. So your 50 would be 100. But we would hope, of course, that property value would have gone up in that time. Yeah. But we can't guarantee that. So we don't really know. We can only look back at the past and think, all things being equal, we would hope that it would do that. Yeah. And the industry, I think, uses a 1% growth. Because no one can guarantee what it will be. Although house prices, I've heard, just yesterday in the last year have gone up 6% in the southeast. In other places in the north, they've gone up by 12. But there's no guarantee of that. No. So the fact is that, of course, it means that the property, even if it never grew in 20 years, it was still 300,000. Your loan would be about 100,000. The house would be sold by your beneficiaries of your estate. They would sell the house. The £100,000 would come out. The £200,000 would go to the estate and be shared by the person's will. Okay. Yeah. So it's the family that sell the house, and they've usually got, depending on the product, between 6 months and 12 months to do that. Okay. And of course, the loan is still getting interest added all the time. It doesn't stop just because the person died. It's until the house is sold. But equity release is done on the house and the house alone. And that means that even if the client had lots of money in the bank, the loan is not against them and that money, it's only against the property. So the property was never worth that money because we had negative equity, something happening with the markets dropping. There's a thing called a no negative equity guarantee, which simply says you can't ever owe more than the value of the home to repay the loan, even if it's less. And that's a guarantee that protects the family. But of course, all things being equal, the amount they borrowed is less than the value of the house. And of course, if the family want to keep the house, the lender just wants the money back.
Yeah.
It's not dependent on selling the house. That's just the usual way that it happens.
Mm-hmm, mm-hmm. It's so much food for thought, isn't there? And I think, there's a lot of, I don't know, I never knew much about equity release, but I don't think it necessarily had a particularly great rap 15, 20 years ago or something like that. Do you think there's a lot of misconceptions about it now that you're having to work through?
Yeah, there is, and I've been in the industry for a long time. We've done a lot to work the industry through the industry to make people understand it's not quite like that. And I think the biggest myth that people probably ask me about is, if I do this, I'm going to lose my house. Yes. And the fact is, you can't, because there's no actual payment that you have to make. You can't default on the payment because there isn't any to make, and therefore you've got guaranteed tenure of your property. Mm-hmm, mm-hmm. Even with the 10%, it's an ad hoc, pay it if you want to reduce it. It's not something you must do, and therefore if you don't, you put yourself in that position. So you are not going to be in that position of doing equity release and finding that you will lose your home. You can't lose your home. You've got guaranteed tenure of occupancy, because it's literally a voluntary payment.
Yeah, that's good to know. And I wonder how many couples go through a lot of guilt because they really want to be able to have that new kitchen or, the U-type jag, but they're worried about how their kids are going to react because, of course, that's actually eating into their inheritance, I suppose. Do you have conversations?
Yeah, I think if you look at the over 75s, maybe a little bit older now, they're probably very concerned about leaving inheritance to their kids and grandkids. It's sort of the priority. Yeah. You come down the scale of age, and I'm over 60, so I can tell you from my age is that I look at it that I'd like to leave my kids some inheritance, but I come first. And we're getting a lot of people now are realizing they can take money out and change their lives, but also quite importantly, unless it's changed recently, I think it's something like a third of inquiries are instigated by the fact that the children have done it, because they've listened to their parents. They've listened to their parents and gone, you can't buy a new car, you can't go on holiday, we can't help you, but we do know this thing called equity release out there, a lifetime mortgage that you could do that could solve that problem. And we're not bothered if we don't get as much of the house. We're more concerned, mum and dad, that you are looked after and you have a good life in retirement. Yeah. And there's a lot of people that do that, and there's a lot of people who are in that age group of myself who actually think that anyway, if you like. Yeah. And if it comes to it and you decide that's what you want to do, that's what we'll do. But there are products out there that also guarantee inheritance as well. So you can guarantee that you're going to leave half of your property behind, but of course it means you can only use half the property in the calculation of getting money release. So if you could release 30% and you want to guarantee half your property, you're basically saying I'm reducing that 30% to 15%. That makes sense.
You might have lost me a bit there, but yeah, I kind of get where you go with that.
Yeah, so if you want to guarantee, so if on your whole property with no guarantee of inheritance, you could get 30% of that out, and you want to guarantee half of it's left to the kids, then it means you can only do equity release on half, which means you can still get,
I see.
Which effectively means you'd only really get 15% of the whole property value out from doing that.
And you may or may not know this question, so sorry to chuck it at you. Do you have to make any amendments to your will, or is that, or not? It doesn't have any effect on it.
You don't have to make any amendments to your will, but it's obviously that, of course, what you have to remember is that if you've got any mortgage or loan against a property, then that lender has first charge on that. Sure. And that will be in the event of death and the property being sold, then that money will go back to the lender, and the residual money that's left behind will then go into the estate. So yeah, just by somebody saying I'm going to leave you my house, the fact that there's a mortgage on it that still has to be repaid in the event of death. They can't just leave the whole house without that mortgage to be repaid first. And that's true of an ordinary mortgage or whether it's a lifetime mortgage.
Yeah, okay, that's interesting. Perhaps one for another time, I guess. And we chatted briefly about inheritance tax yesterday, and you mentioned about how if you are gifting your children or grandchildren X amount of thousands, remind me, is there like a 7-year window? Tell me about that.
Yeah, so basically you have any estate that's over the threshold for inheritance tax, of course, then that means there's 40% inheritance tax to pay on it in the event of death. But if you gift money away, whether it's through extras or gifting your own money to children and alike, is then basically there's a rule that simply says that after 7 years, it comes outside of the inheritance tax threshold.
Mm-hmm.
It's a reducing scale down, which I can't remember on the top of my head to tell you, but it's 40% and it goes down over the 7 years to 0. And after 7 years, that means that money you give, so if you've given 100 grand to one of your children, that means that it's still applicable if you died that day to 40% tax, okay?
Mm-hmm.
But every year it goes by, that tax rate is reducing. So once you've lived 7 years after gifting that money, it means it will be 0 that's owed on that amount out of your estate in future.
Mm. It's you've made it sound as easy as possible, I think. Thank you very much, Chris. It's complicated. Well, it's complicated. It's complex, and there's lots of ifs, buts, and maybes, isn't there, involved in everybody's own personal family setup and financial situation. And
there is, and that's why talking to me and getting information and just finding out some of these things can put people's minds at ease about what it does and how it works. And then, of course, when and if they decide they want to do it and they see an advisor, they will look at that far deeper than I will, so that it's all tailor-made to their life and their lifestyle and what they want and what they need to achieve, which is really important, because it's not just a case of going and saying I can borrow some money and do something. You need to make sure it's right. Yes. And it needs to make sure that it's done properly, and it needs to make sure that you get the right advice and end up with the right product at the end of the day.
Yeah, absolutely. Thank you. And just the last couple of questions, I guess, then really. In a short version, what's the process? So if someone was really keen on talking to you about this after watching this, what are the steps? What would happen?
Well, first of all, they should let you know they'd like to do that. And then with their permission, you can ask them to call me, or you can ask their permission for me to call them, and I will do that. We will have a chat at a convenient time. Usually takes, I don't know, half hour, 45 minutes tops. And I'm of an older generation, so I tend to get on better with people because I've got grandchildren and children as well, and so we've got something in common. But more importantly, it's about finding out whether it's right for them. And if they decide to do it, then what they do is I will then arrange for a local advisor who will then come and see them and do what's necessary, as we just said a moment ago. Mm-hmm. The advisor will come back with his recommendation. If the client likes that, then it will go to application. And actually, it basically takes between 6 and 10 weeks to complete, and then the client gets their money. Okay, mm-hmm. There is a cost involved. It does cost something like around £2,500 in fees, thereabouts, mm-hmm. But it's usually payable at completion. It's usually taken out at completion time. There's usually no money up front, and of course, what I do is free. What the advisor does is free up to the point that they say, I want to do the application. And then there are costs involved, which will come out later. Yeah, no, that's fair enough. It's good to make that clear as well. So I think sometimes some of the fear around even exploring these things is even having that chat in the first place is going to cost £100 or something, that, but it's all completely free, and you can chat to your heart's content pretty much, and make sure it's the right thing for that person. And then when they press the button, say, yes, please, let's do it. Then of course, they'll have the advice up front to know how much it's going to cost. And like you say, reassuring to know that that money can actually come out of the money they're borrowing. They can add it to that as well, because basically extra leases for people who are property rich and tend to be more cash poor, and quite often haven't got that amount of money they want to pay. Some people pay out their own money, but do remember, from the point of view of when people talk to me, it's free information, no obligation. They'll be under no pressure to do anything. It's about doing it when it's right for them, and it might not necessarily be now. It might be in 3 months or 6 months time. But I do keep in contact with people so that we're finding out whether things have changed for them. I don't just dismiss them. I like to be there for a certain period, but after a certain point of time, if they've not made a decision by then, I then leave it for them to say to them, come back to me when you decided you're ready, because it's not for everybody.
No,
It's a lovely product. It's out there to help you with things, but it's not right for everybody. And sometimes we will tell people that because there'll be certain circumstances where we'll probably say, you don't need to do it because of X, Y, and Z.
Maybe, or
yeah, I mean, we've had people who've had lots of money in the bank and wanted more money in the bank, and it doesn't make sense to put more money in the bank. It makes more sense to spend the money that you got and get it to a point, and then say, right, now we do it because it makes sense. We haven't got all that money anymore. But we will look at that with people, and there are times when we will say in those sort of circumstances that it's not something we'll do for you yet. But once you've spent it, then please come back to us, because that's the time when you need to look at your options.
And I think that's really great as well, when you're thinking ahead, if you can start to think ahead as far as you can, a year, 2 years, 5 years, just having this information up front, it gives you that reassurance, doesn't it? So that you know that when you're looking at a certain portion of your life, think, well, hang on a minute, what options have we got? Don't forget, we've got that, or we can go down that road. I think just having those options, and you're not going to feel that fear of, oh my God, what am I going to do? Because you know in advance of what you can do.
Yeah, you're absolutely right. If there's something and you know what those options are, and even if it's not right for you right now to do it, that in a year or two, when you think, actually, I know about that, I might look at that and do that because I know. But like there's an old saying, you don't know what you don't know.
Yes.
And there's a lot of people out there that have misconceptions about equity release. They fear they're going to be sold it. They see all sorts of problems, but that's why I set my business up, so that they can talk to somebody, not have those fears, find out about it, recognize it works for them or it doesn't work for them. And it might be that I'm saying to them, there's a different solution to this. It might be a conventional mortgage. It might be doing something completely different to what they thought and hadn't really considered. And if it works, it'd be great for them. If it doesn't work, they can't do it, they can still come back to the equity release and look at it again.
Yeah, fantastic advice. And just very, very quickly, lastly, for that conversation with you, Chris, should somebody have prepared anything in advance? Do you ask questions that it's helpful if they have that information already, or?
The only thing I need to know from them is going to be their ages, dates of birth, their house value, whether they've got a mortgage or not on the property still. And generally, that's the bit. Everything else they'll know, because if I say how many children have you got, I hope they know. And they'll know what they want the money for.
Yeah.
And they're the things that I don't need them to ask them to have that prepared, because they'll know what it's for in the conversation. But the house value and their ages is important, because it tells me how much I can get cash for them.
Yeah.
Because if they're coming to me and saying we want an amount of money, and then I look at their ages and I look at what can be taken out, I can determine whether I can match what they're looking for. And it might be that we might have to talk about them perhaps lowering their expectations for a few things, so they can cover most of what they want rather than all of it. But if it's repaying a mortgage, of course, it has to be the amount of money, unless they've got some capital they can put in with it to balance it up.
And does it have to be an official valuation of how much their house is worth, or is it got to be a really good rule of thumb, looking at where they live and what other houses are selling for?
For them at this stage, it's really just looking in the market and just seeing what they think it's sort of worth.
Right.
I think most of us generally have an idea of what our properties are sort of worth.
Yes.
But during the process with the advisor, if they do an application, a surveyor will be employed to do a valuation.
Yeah, fair enough.
Of the property, and of course that would be the market value, and that's the value that will be used to determine at their age what percentage they can take out of the property at that value. So if someone tells me a property is worth 500,000 but it's only valued at 400,000, it's not going to give them the amount of money that I told them they could get because of that. Equally, if they tell me it's worth 500,000, it's worth 700,000, there's more money that they could get than they thought.
Days,
If they
yeah.
don't, it's usually a problem if they've overestimated and if they need the maximum.
Yeah.
But if you don't want the maximum, it doesn't matter if your valuation of the property is a little bit less, because it's not going to make any difference to the client.
Chris, you've been fantastic. Thank you so much. And we'll put the details in the description box below. And of course, in terms of the website, Chris's details are all on my website, budgetingandplanning.co.uk. Thank you very much.
Lovely. Thanks, Lucy. Take care.